Let's welcome in the management at Capital First now. Mr. V. Vaidyanathan is now joining us. I think this is the 8th or the 9th straight quarter where the growth on a YOY basis is looking pretty strong. Mr. Vaidyanathan, congratulations on a good set of numbers. Could you just give the highlights of this quarter, this entire year, what has happened at Capital First?
First of all, thank you for appreciating the results. Basically what has happened is that the loan book of the company has grown by 25% and the profits have grown by 44%. That is a clear explanation that the operating leverage of the company is growing. One of the key factors is that the retail loan book for the company, which is a key focus area, which is both MSME loans as well as consumer loans, has grown 33% to reach 18,800 crores. So as far as the quarter's profit is concerned, the key factor is that the NII number has actually grown from 255 crores last quarter same time to 375 crores fourth quarter of 2017. So that's 120 crores increase in NII. That is translated to the bottom line.
Right. Can you just tell us the NII performance and the margin? Is it sustainable? At least these margins are sustainable?
Definitely the margins are sustainable. We actually think that the margin should actually increase next year, mainly because the cost of funds is continuously coming down.
Right. But do you think that this cost of fund, the tailwind of rates coming down continuously is now behind?
No, it's not because of the tailwind of cost of funds coming down. That is usually passed on to the customer. It is only the mix of the funding that is changing. We're incrementally not borrowing from banks. We're incrementally borrowing more from mutual funds and from provident funds and from multilateral financing agencies. They are about 30-40 basis points cheaper than bank borrowing. So that is the reason why the margin is expected to increase.
Right. Mr. Vaidyanathan, if you could just tell us, what sort of opportunity is still there in the urban NBFC companies that essentially you are catering to. Still there is a lot of market share from banks which are struggling for capital versus them, what companies like you can take?
See, the fact that existing banks sort of market share coming to NBFCs is just one part of the story. I think it's not the whole story. It's only a fractional part of the story. The real story is about how much of the financing is not being done at all today by any lender whatsoever. The organized financing for MSME sector is just about 8 or 9% of their opportunity space. So that is a big area to grow. We are focusing on that.
Right. In terms of retail side, so we get this credit number which comes from RBI on a fortnightly basis, and it seems to be just not growing. It used to be around 8-9% earlier. Now it's around 4-5%. But still, you think for NBFC, for private banks, the credit growth opportunity is still very high. They can still continue to grow 20% plus.
It's a good question, because when you're looking at the macro situation and growing at 4-5%, you might really wonder sometimes how something growing at 25%. It's a fair question. But actually, the 4 or 5% credit growth is a little understated because a good portion of financing is also happening through the debenture market by the same banks who are actually lending in the form of credit. So adjusted for that, credit growth should be higher. As far as the sector growth is concerned, the retail sector actually has been growing faster. It is only the wholesale sector financing to oil, let me say steel, iron, and the capex structure has been coming down. So in a real sense, the consumer credit has been growing in any case.
Right. And in terms of consumer credit bureau agencies have done a great job. So the chances of NPA are pretty scarce.
Well, it's a very important factor in the growth of the Indian banking system and the financial services system, that the credit bureau is not one. In fact, there are 3-4 of them, which is CIBIL, there is Equifax, there is Experian, there is Highmark or CRIF. So it's a very large, it's a big development in terms of credit quality. But credit quality in any case for sectors, for mortgages, for home loans, and for such sectors have actually behaved very well. Actually, it's just not been a one-year story.
Right. Also, if you could just tell us that companies like you, which have recently started consumer durable or this sort of financing, do you think that now it's much more of a process-driven system, and that's why human involvement in or any arbitrary involvement in terms of any loan giving is now absolutely behind?
Definitely, because there is no arbitrage, no human decisioning process in some of these small ticket loans, because small ticket loans are just not viable if done the physical manual way. That business has been growing really well for us. But I must also mention to you that these businesses, even though you are bringing a lot of automation, in an operating expenses sense, these businesses have very high operating expenses. They tend to have higher credit losses as well. But all in all, I think these are nice businesses to grow at 20-25% per year.
Right. Can you talk to us about asset quality at Capital First? It continues to be steady, almost as good as zero.
I'll share the numbers with you. Assuming 120 days past due as the benchmark for the last year, our NPA was about 1.33%. At the same 120 days past due, which is what we reported in March of 2017, the NPA is less than 1%. So even gross basis come down by 30 basis points. On a net basis, net NPA is 0.3%. So I think this can very much continue. In fact, I feel the next year is actually going to be better because of the amount of the demonetization. What has happened is that the cash money has come to the banking system, and for us to collect the monies from the bank is easier than collecting in cash.
Right. Can you also, just talk to us about, what's happening as far as NPAs are concerned? Really, there is no concern, at least on the retail side of the market, not only for you, but for the industry?
Absolutely, because the end use is actually a product to use, maybe a home or a car. So there is a real. The second part is that the income assessment of the customer is done at the time of giving the loan. Compare this with maybe capex or project financing, where the cash flow of a project depends on whether the customer pays you back or not, and that can always be tricky.
Right. Always people say that when you grow in size, your cost come down. So when you continue to grow the way you are, you expect cost to income ratio to come down, may not in FY18 but in FY19?
Yes, cost income ratio does come down over time, but the nature of businesses of giving small loans is such that costs also continue to pile up. But all in all, it is safe to say that operating leverage has come in. Cost income right now about 50%. We think it should come down in the years to come.
Right. What happens, on the capital position when you are growing at 20-25%? Will you need to raise capital next year to maintain this growth level, because you have to maintain a certain amount of leverage?
Well, what happens is that the underlying profits also continues to compound. For example, last year our profit was 165 crores. This year it is 239 crores what we reported. We certainly expect next year to grow at a compounded rate from here, even in terms of net profits. So that also provides capital for growth. And therefore we do not expect to raise any capital say the next maybe in the financial year of 2018.
Right, that was about the results of the company. Now let's talk about the macros. What sort of sense you get? You track the macros of India pretty closely. What is the sense that you get? Is it the correct time for a lot of investments to come into the country?
This is actually just the right time, because I think there's a lot of bad news that have been digested over the last 6 years. One phase was ending with 2014 or 15, when the macro was in very big trouble. Between 14 to 17, let me say, macro has largely been fixed. The inflation numbers, the growth numbers, they all look to be pretty good. So the point therefore is that this is really a good time. Three big factors will play up in the next 1 year. The GST will come in, which will be a landmark moment. Tax rates for small companies have come down. Interest rates have already come down. So I think these three engines will fire at the same time. So 2018-19, by our estimate, should look really good for India.
Right, and overall, when we talk about the economy, whenever the pickup happens in infra and capex, it will just happen. It will come with a surprise. It can happen now, it can happen later, or maybe after 12 to 18 months.
Definitely, because with the consumption picking up, eventually consumption has to lead back to investments, because people have to produce for someone else to consume. So that cycle has always lagged consumption by maybe a year or so. So since we're seeing strong consumption coming back now, let me say capex investment is just exactly 1 year away. So it might just surprise people on the upside if you watch this 2 years from now.
Right, and just in terms of the existing capacity that is there, do you think once the capex, the demand return backs, at least for the infrastructure side, first signs of pickup would be visible?
The big role being played by in the economy right now is not from the private sector, because private sector has been rather comatose over the last 5 years in terms of investment. But the government capex of 3,96,000 crores that they have planned for investment in 17-18 is literally staggering. So that will definitely fire up proceedings, and it will have some cascading effect on consumption also.
Right. Just about rates in the system, I'm talking about the interest rates, the bond rates that are there. Do you feel they can go down further, or now there'll be a pause over there?
Well, there is a pause. There has been a pause, and maybe there will be a pause for another 6 months. But structurally, it has to go only one way. It has to go down. And if you take a 1 year forward, definitely it should come down, because there is so much of flush of liquidity, even post demonetization, and so much of liquidity, not much credit demand. So interest rate have to head down.
Right, but in the near term, you don't see that happening?
Not in the near term, because I think the credit policy, or also the monetary policy that came about a month ago, made it clear that there are some concerns they have got to watch out for.
Right, Mr. Vaidyanathan, thank you so much for taking out time for us. Always good to get a perspective from.
Thank you very much.